Hello, hello. Get a mic check on here and make sure everything is good. Start in about 2 minutes. It shouldn't take longer than 30, 40 minutes. This is not going to be a slideshow this time. Just letting you guys know in advance. I really like the slideshows. I don't know about you guys. I come from the corporate world. I worked at Merrill. I sat through meetings. I like slides. I got some constructive criticism from people saying, hey, you know what? Maybe the slides are just a little bit too heavy. So in this time, we're going to restructure the way this goes. And I'm going to talk through, it's going to be more hands-on, right? We're going to flip through different websites. We're going to flip through different charts. So instead of you guys just sitting here reading slides along with me and me talking through concepts, we're going to try to dive in and make it a little bit more interactive, okay? So give it about a minute and a half, and we're going to go ahead and start. IWM looks fantastic. We're probably not going to touch a whole lot on IWM, but I'll give you a hint. Obviously, if you follow me on Twitter, there's something called the January effect, which is essentially small caps catching a bid. Generally happens at the beginning of December now. Each year, it tends to come a little bit sooner, but we're starting to get that January effect already in the markets right now. So we undercut that 3-year low. Everybody was bearish, including myself. And then we get a huge thrust in the market. All 3 major indexes pop up into new highs. Now you have IWM back in the game. We're going to see that in a second on Koifin. But if you're following me on Twitter, go look at the actual stats. I post them on there. I tell you about the January effect. I actually throw, I bought the stock market almanac. I don't know if you guys are aware of it or not, but it's a really data dense book. I love it. And I post little clippings from it all the time, and a lot of it has to do with small caps right now. So, yeah, small caps look good. All right. So once again, let's go ahead and start. This is not going to be a slideshow this time. This is going to be a little bit more interactive. So I got the questions, or I got your guys' chat up here so I can actively work with you guys this time. It's a little bit more hands-on and crowd-friendly. So let's go ahead and get started. My name is Hamilton. I'm here with the Trading Initiative. I'm going to show you how to make $1 million. It's super easy. Just kidding. None of this is financial advice. I'm just simply showing you how we view the markets inside of the Trading Initiative. Hopefully you guys learned something from this. I'm going to go ahead and start with, if you were here for the Wyckoff market model, Stan Weinstein, absolute GOAT, right? Legend in the market. Let's talk through something that he finds incredibly important when it comes to trading. It's not just the stock that's important, but it's the sector, industry, market cap, etc. He says, my studies have consistently shown that 2 equally bullish charts will perform far differently, if one is from a bullish sector while the other breakout is from a bearish group, and I'm going to prove it to you shortly. So Stan Weinstein figured this out in the 80s. Richard Wyckoff figured this out 100 years ago. Charles Dow figured this out over 100 years ago. This is absolutely something that you should implement into your trading immediately if you haven't already. It doesn't have to be the main crux of it, but it absolutely will give you an edge. Okay? So first things first, I want to talk about, let's flip over to TradingView really quick, and I want to talk through if TradingView actually works. I got the Stream Deck up. Is it not going to work? There we go. I guess I just got to do it by hand. I love how I set everything up. It was working. I go live, and it's not going to work. Really quick, I want to update a definition for you guys. And like I said, this should be real time. So you guys can be able to answer this stuff real time. I'll wait for you guys to answer it, right? What is absolute strength? What does that mean in terms of trading? I used to work at Merrill Lynch. I left a long time ago, but yes, I was a financial advisor at Merrill for quite a while. What is absolute strength in the market? And then think about it in terms of relative strength. What is the main difference between the two? Relative strength is not the RSI. It's an indicator that measures momentum. I have it on. But it's completely different. Persistent momentum, that's actually pretty good. I have not. No one's ever said that. It's actually not a bad definition. I'm going to change it a little bit there, but I totally don't think that's wrong. Absolute strength is when price is just going up. That's it. Is it an uptrend? Then yeah, price is going up. That's it. Absolute strength is just price is going up. It's a stock that if you're long, you're probably making a couple bucks. What is relative strength? If absolute strength is price is going up, relative strength is price is going up faster than stocks around it, within the same basket, within the same industry group, within the same sector, etc., right? Yes, yeah, great, perfect. So Obsessed Trader says absolute is measuring an asset against itself. Relative compares it against a group. Absolutely right. So Stan Weinstein, all of these great traders, they focus on two things. They focus on obviously absolute strength, prices going up, but they also mirror it with relative strength. And that's what Stan was saying. We just read it, that stocks that come from bullish sectors tend to outperform stocks that come from less bullish sectors. Even if the setups are the same, even if they're both showing absolute strength, the backside of that, if it's coming out of a strong sector, a strong industry group, etc., it's probably going to outperform over a longer time period. So that's the main difference between relative strength and absolute strength. I think that's important indication between the two. So let's go ahead and flip back. And let's talk through the stats of this really quick. So if you don't know, I'm about to put you on to the absolute most incredible guy you're ever going to meet and learn about inside of technical trading. His name is Thomas Bulkowski. Guys, I'm going through the CMT level 2. I take it in about a week and a half. The CMT is a chartered market technician, all right? And essentially, if you pass all 3 levels, you get the CMT designation at the end, and you get to be a big dick, professional, technical trader. It's really cool, right? But realistically, this Thomas Bulkowski guy is referenced inside of the CMT material almost like a prophet. I mean, this guy has done more for TA than anybody else, I think, in recent years. And essentially what he does out of his own free will and posts all of it for free online is he quantifies all of the different types of chart patterns, all the different types of candlestick patterns. He really adds validity or debunks a lot of the stuff within the technical space. All right? So if I'm putting you onto this guy for the first time, his website is thepatternsight.com. Highly suggest checking it out. I read it every single day, and I've been doing this for 14 years. There's always something new on this website that you can learn from. I'm going to focus today on industry relative strength. Okay? Obviously, that's the focus of today's webinar, is this idea of relative strength amongst sector, industry, market cap groups. And what I want you to focus on in particular, if you want to take the time to read this, feel free. It's thepatternsight.com/industryrs.html. But I just want you to take a quick look here at industry relative strength results. And this is basically to prove to you, not, hey, I can show you all of the quotes in the world of these smart guys that make money over time, and they're telling you to do this. But until you actually see it and I prove it to you with numbers, maybe it goes in one year and right out the other because you got some asshole on YouTube in a fucking Lambo buying symmetrical triangle breakouts. Not sure if you guys know this, but it's not going to make you a millionaire buying symmetrical triangle breakouts. But simple concepts like this, buying stronger stocks and industry groups, have better odds. And Bulkowski goes ahead and quantifies this. He goes, if you quantify, I guess, if you categorize the different types of industry groups into 4 different groups, right? Group 1, Group 2, Group 3, Group 4. And then within those groups, you rank them within each group. So stock number 1, group number 1 is going to be top rank. Stock number 4 is going to be middle rank. Stock number 8 is going to be bottom rank, right? Look at the outperformance in group 1, rank 1, over the course of 2 years compared to everything else. Now, obviously, most of us aren't going to be trading stuff for 2 years. I understand. Inside of TTI, our focus is 60, 90, 120 days. We're swing traders, right? We're more than short term. We're kind of that intermediate time frame here. And so we're looking at this 3-month stat here, sometimes a 6-month. It depends on how far we're going out. But look at the outperformance in the top rank over each month. Month number 1, the best stocks generally outperform even the second best stocks by 5%. Go down to 2 months, it's double. Go down to 3 months, it's more than double, right? And it exponentially increases. Go down to 2 years, 98% compared to even within the group number 1. The worst stocks within group number 1 outperform everything else. But look at how much they underperform the top stocks. This is incredibly important. Over time, buying the strongest stocks in the strongest industry groups has been proven to give you an edge in the market. There's no dismissing that. If this is a part of your system, it's incredibly important to live by this. You're constantly looking for the strongest stocks. Now, this is where it gets hard. How do you actually go find the strongest stocks? I'm going to show you how we do it inside of TTI in 2 seconds, but I need to beat this concept into you, that this simple concept, and it is simple, it's hard to execute, but the idea is simple, will make you more money over time than almost anything else. Stan Weinstein says buy stage 2 breakouts. He also says buy stage 2 breakouts in the best industry groups. That is the way that he traded, continues to trade. That's how all of his material is set up. Most top-down portfolio managers, swing traders, Position traders, money managers trade this way as well. They focus on industry groups that run together, and then they find those individual stocks within them depending on how big their account sizes are and whether or not they have rules and regulations that allow them to buy individual stocks, right? So once again, thepatternsite.com/industry-RS, and you can go and dive into this. Read the entire study. Take this. This is the brunt of everything that we do inside of TTI relative strength, right? So next thing we're going to do is Koyfin. If you don't know what Koyfin is, this is probably my favorite program that we have available as retail traders. It's relatively new in the sense that I think it's only like 5 years old. I've been using it for 4 years, and it's fantastic. So I had access to a Bloomberg terminal at Merrill. I was not a trader for Merrill, so I used Bloomberg in my free time. It wasn't really necessary. This is number 2 to what I was able to get my hands on at Merrill. Koyfin. Why? Because it puts macro analysis in the hands of the retail trader without having you code through Python. You can use OpenBB and run it like a terminal, but this is the easiest way to find the information that everybody uses on Bloomberg. So use it. It comes, I don't know if there's a free version anymore. I think I pay like $40 a month for this. It's worth every penny. So when we flip through this, you can go to market dashboards here, go to US sectors, and as you can see right here, we have all of the major US sectors on the left. We have sectors, industries. We're going to run through both of these. Inside of TTI, we normally start with year to date, right? We'll start with year to date. We're just going to stick with this. I don't need to make it more complicated. I do that shit too often. If you're inside of TTI, you know what I'm talking about. Year to date. What are the industry groups the sector groups that are up the most here? Well, if you said tech, communications, and consumer discretionary, congratulations. That's what's been leading the market all year. But could you have made that same distinction back in April? Could you have made that same distinction back in March when they started to break out? Could you make that distinction on October 27th when the market started to pivot? That's where this stuff comes in handy. Specifically because inside of a bull trend, right? Inside of a bull market, which regardless of what anybody fucking says, this has been a bull market off of the October 13th low of last year, 2022. Doesn't have to be a strong bull market, but by all definitions, more stocks are going up than down. That's what this shit means right now. Breadth is expanding. Breadth was expanding. And the major indexes were up over 20%. That is by definition a bull market. It doesn't matter if it's the Magnificent Seven that's pulling everything along with it. If you tried to short the market all year other than aggressively shorting it in little opportunistic spots, you probably have had a bad year because it's a bull market. When this flipped at the end of October, October 27th, which sectors continued to lead? Which sectors rebounded the most? The sectors that were leading all year. So off of that October 27th pivot inside of TTI, we did not buy the absolute bottom on the 27th, but we did pull up the year-to-date chart and we go, which sectors have been leading all year, and are they bouncing along with the broader market, or are they bouncing more than the broader market? And the answer was more. So if we actually come down into the 3-month, you can see tech. It's tech. Tech. Now it's easy in hindsight, right? But tech was leading all year. So was it reasonable to assume that tech was going to continue its leadership role when the market finally found a floor? Yes, it is. That's how these things work. Relative strength, absolute strength. When you find leaders, they tend to lead longer than most people expect them to, tech, communications, etc. Right? So when we bring down the time frames here, you can go from year to date to 3-month, you can go to 1 month. Once again, tech's in the lead. It's easy for me to sit here and preach at you that you should have bought tech a month ago, but we did. We still have tech on the books. We expect it to continue run for the next month and a half, maybe 2 months before really any sort of drawdown. We were able to find trends through Koyfin utilizing this sector performance going from year to date, quarter to date, 1 month. And if you're really crazy, you can come down here. And this is this 5-day type of time frame here is important, I suppose, when you're trying to identify trend pivots like absolute reversals, because you can see on a relatively small scale how hard things individually bounce. But understand that if you're a swing trader, if you're a position trader, 5 days does not give you enough data to really start to say trends are changing. It's a good start. If we start to see, for example, look at finances up the most over the last 5 days, that's different. Ever since the regional banking crisis in March, financials have been beat to shit, but now all of a sudden financials are starting to lead a little bit. That's different, right? So you can take this information, put it in the back of your head, and it will help you look at different types of stocks in a different light. Financials are outperforming SPY going back to October 31st. That's different. So for the last 20 days, financials have outperformed the S&P 500. That's different. There's a little hint here, right? We're finding relative strength. This is outperforming the broader market. Maybe there's an opportunity there. I'm going to show you one in a second, actually, that we took. It's going to be a little bit later, actually. But this is essentially how you can discern between strong sectors and weak sectors. You can also use something called a relative rotation graph, RRG. Stockcharts.com has a really good one. I think it's paid. It gives you this exact type of information, but it's in a quadrant format, and they rotate around, and they have like tails that go out 20 weeks, and you can see the gradual progression of sector strength. It goes like this, moves in a circle around these quadrants, and you can start to find where stocks are coming out of lagging and into improving, stocks moving from improving over to leading, and you can start to look at baskets of stocks within that realm as they start to shift. This is incredibly important, as I already proved to you through Bukowski, that if you can catch this stuff early enough, you might be able to grab something that you can hold for a very long time and watch it outperform. So as of right now, tech, communications, consumer discretionary, this is where the brunt of our cash is invested in the markets right now. We were able to start getting long October 31st, November 1st. So we did not catch the absolute bottom. I'm not going to talk about all of the nuances because it's not just the bounces here that influenced our decision to start getting long on November 1st. There was a lot of different stuff, but this is the entire reason why we focused on not buying industrials. We didn't buy consumer staples. We didn't buy healthcare. We didn't buy energy. All of this stuff is underperforming SPY year to date. All this stuff is underperforming SPY 3 month. And if you go back to the 1 month, which is realistically, we'll use quarter to date here. Well, I guess let's use month to date because the market really did bottom on the 27th of October. So we're getting back to October 31st here. There's no reason to be buying anything underneath SPY. It doesn't make sense. Buy the stuff that's leading the market. So once again, tech, consumer discretionary, communications, those are where we were entirely focused, and that's where we're going to continue to be focused. But this is the best part about this specific style of trading, is once we have these sector groups, we can niche down even more. And this is where it starts to get as complicated as you want it to get. So Koifin gives us, I think there's 17 or 18 industry groups here. IBD, if you're privy of IBD, there's like 150 industry groups. So if you want to rack your brain around that, feel free. We don't do that, but there's nothing wrong with that. It just dissects the market even more. But what you do once you figure out, okay, I understand which sectors are leading the market. Each sector can be sliced up into different industry groups within that sector, right? So if we know, for example, we want tech. Well, there's 3 main groups inside of Koifin that are a part of tech. It's semiconductors, software, and internet names. And it just so happens that semis are leading, software's up there, and internet's up there. It shouldn't be a surprise. We already saw that tech is leading the market. Is it surprising to see the different industry groups lead that sector or lead other industries? Excuse me. It shouldn't be. That's how this stuff works. But what we can do, once we figure out we want tech, we can ask ourselves, is it better to own a semi name or is it better to own an internet name? Year to date, semis are up 60%. Internet names are up 35%. So from an opportunity cost standpoint, it makes more sense to try to buy a semi name in recent strength more so than an internet name because semis are leading. That's the whole point of this. Software is up there as well. So once again, we can niche down. Let's go to 3 month. Software has been leading over the last 3 months instead of semiconductors. Let's go quarter to date, semis and software. So that's realistically where we want to be long with a lot of cash. We want to be long semis and software. For those of you that are watching this inside of TTI, what are we long right now? Semis and software. None of this is random. Absolutely zero of what we do inside of TTI is just flipping through random scans and going, this looks like a good setup. All of it comes from this specific analysis. Understanding where it is being recorded, it will be posted. All of it is coming from this sector and industry analysis portion of Koifin. Right? So as of right now, the only area of the market that I wish we had more exposure in is home builders, but this is a harder industry group to get long if you're an options trader because the volume on the chain is rather low. But look at some of the groups over this month starting to pop up over SPY that are brand new, right? We're starting to get water resources. That's random. We got solar names coming off of the floor, regional banks. There's that financial space that we were just talking about. Financials are starting to outperform. Regional banks are outperforming. Hint, hint, giving you guys a little elbow nudge here. This is a beat to shit sector and industry over the last 6 to 7, 8 months, going back to March, and all of a sudden it's starting to outperform. Get rid of whatever bias you have in the back of your head about banks blowing up because the charts are starting to tell us that maybe it's time to own some of these. We're starting to outperform the major indexes, right? We'll go to 5-day just to do it because we did it with sectors as well. And look what's up and over SPY right now. Software, Retail, who would have expected? We just had a bunch of earnings come out with retail. We had Ross is up near all-time highs. Target gapped up huge after getting sold off for 2 years. Abercrombie and Fitch is up near all-time highs. American Eagle got donked today on earnings, but they bounced back. They got bought up all day. I think they're still down, but all of this type of stuff matters, right? So the 5-day, once again, does not show you a trend, but it can start to build the beginnings of, hey, that looks weird. Normally, we're not seeing this start to outperform. You can go to 1 month, start to confirm that 5-day twist, right? And you could hover over this and see the rate of change in trend, and obviously go out farther and farther. And then all of a sudden, you're starting to see trends change on a major basis, and that's when you should really get in. I'm going to stop for 1 second, and I wanted you to look at, we'll just stick with this 3 month, which industry groups right now over the last 3 months are the clear winners. Software, semis. Everything else is underperforming the market, at least those two market leaders. It's software and it's semis. Software, what are the largest companies? Microsoft and Apple. Semis, what are the largest companies? NVIDIA, AMD, MU, TSM, all of the different semi names, right? Let's go over to Bukowski. So I told you IBD has an industry like grouping thing of like 120 industry groups. Feel free. I don't know if it's free, but if you want to pay for it, you can go and look through their stuff. Bukowski does it for free. It's a little less robust than IBD. You can go to rsupdate.html off the pattern site, and he updated this last time, November 17th. And through his individual analysis, he said software, semiconductors. So what we just did with Koyfin is what Bukowski is doing with whatever methodology he uses to find industry groups. And then if you go over to IBD, software and semis are in the top 5 again. All of this stuff is interconnected. There is definitely a little bit of self-fulfilling prophecy. When everybody is looking at the same industry groups that are hot, you have to assume funds are going to continue to flow into those industry groups. That's how this shit works. And Bukowski does a great job kind of giving us a rundown on what type of stocks are leading here. And the one that first one we bought off of the October 27th pivot is this Microsoft play, which is obviously at all-time highs. It ended up being a fantastic grab. We're still long, but this is how all of this stuff works. It's all Bukowski site looks so outdated. This is a GeoCities website from 98. God bless this guy's soul. 100%. I even turned the ad block. I think I have it on right now. I normally turn it off. I'm giving him his pennies. This thing is spam central for ads. But the guy's like 60 years old and he puts so much time into this shit. I will click the fucking ad to pay this guy 5 pennies. It's totally fine. And he still uses AOL. You're right. He has an at AOL.com email. It's super fantastic. As a matter of fact, this has nothing to do with what we're talking about, but I think there's a picture of him. There's his dog. You can already tell the type of guy he is. No shade. No shade there. I don't know where he's going to be. There's a picture of him somewhere. But he's exactly what you would expect, okay? Not, once again. Anyway, great guy. He's doing us an incredible service, so I'm not going to sit here and throw any shade at him. But you saw the confluence, right? Industry groups that we found, sectors that we found inside of Koyfin is being validated by other types of analysis as well. This is good. This is what technical analysis is all about. Everybody doesn't have to use the exact same methodology, but you should come up with relatively the same types of ideas if you're looking for the same thing. Last thing I want to point out, and this is kind of where TTI deviates a little bit here, right? TTI goes one step further. So not only do we have sector and industry groups that we can rank and we can figure out where we want to be long, but we can also dissect market caps. And some of you guys at the beginning were talking about IWM, small caps. Well, I want to show you something really quick. If we go to year to date, is it a surprise to you guys that IVW, which is large cap growth, is outperforming the broader market by 4%? Shouldn't be a surprise, right? Magnificent Seven, everybody fucking complains. My suggestion is just go buy Magnificent Seven and stop bitching about breath. If the market's moving because Apple's going up, go buy Apple and shut up. That's it. That's an easy way to fix that problem. But realistically, year to date, large cap growth has outperformed the market 4.41%. Everything else is underperformed. So when people say large cap growth is leading the market, they are absolutely right. It's just up to you to do something about it. But let's look at some of the small and mid caps, right? We started to see a resurgence in IWM, but look at these trends all year. We've had a couple opportunities to start getting long, and then the market just sells them right back off. So this does not look great. If you have a finite amount of capital to trade with, and most of us do, I don't know if there's anybody here with infinite money glitch. If you do, hit me up. I want a Porsche down here in Brazil. You should be allocating your resources in the areas of the market that are outperforming. And from a market cap standpoint, it's still large cap growth. This is the area of the market that is outperforming. On year to date, let's go to 3 month. 3 month, it's still large cap growth. And this is where we're starting to see, this is the resurgence of IWM. We started to actually go long some small and mid caps because IWM got back inside of a trading range that we had been in for the last 2 years. We undercut into 3-year lows. We saw a pop on an absolute basis. We started to see a pop on a relative basis. But since then, it hasn't really done a whole lot. This isn't invalidating the potential pop. But look at small cap growth, man. If you guys know anything about risk sentiment in the market, small cap growth tends to lead in risk-on environments. It doesn't have to outperform necessarily, right? Individual stocks and stuff, but this generally turns before everything else, and it's still dying faster than everything else, right? I am recording this. It will be posted afterwards. Yes. IWO is still not catching a consistent bid, and that's starting, that's information we have to take into account. Is it time to really start going and buying small cap growth? Is this a time to be doing it? Probably not, at least not like everybody expects. This January effect that's kicked in doesn't officially start until the beginning. I think it's the second week of December when small caps traditionally rally. But we are starting to see some breadth improvement, so it's not necessarily the end of the world. We're just not seeing the type of movement where you want to YOLO port everything long IWM. As a matter of fact, over the last month, IWM has underperformed SPY by 1.17. It's not the worst, but it's not, go long and forget about everything until next year. It's just not there. So, like I said, inside of TTI, we formulate from a market cap standpoint, where do we want to be long? Let's go back to year to date. Let's actually set the stage here, and then I'm going to show you how to build a scanner to find some of this stuff really quick. So let's start with market cap. If I asked you from a year to date standpoint, what area of the market makes the most sense to be long right now? It's large cap growth. This is it. So once we've decided we should probably be in large cap growth, we can go to US sectors once again. What are we looking at here? We're looking at tech and we're looking at communications. Think to yourself really quick, what's in large cap growth? And you'll see it in a second, but it's always nice to run this mental experiment, I suppose. What is in large cap growth that tech and communication sector holds? Well, you got Microsoft, you got Apple, you got CrowdStrike, you got Adobe, all these different software companies, Salesforce, all of these things. Those are all tech companies. So we know that maybe something's going to be there. What about communications? Communications, we have Google, we have Meta, we have Disney, we have Netflix, right? We have those types of media services companies. Okay, cool. All right, so when I pull up the scanner here, I should probably find some of those. But once again, we're going to take it one step further and look at US industry groups. And that's when we niche down to, all right, within tech, we see semiconductors and software. Internet might not be bad, but why would we buy an internet name when we could buy a software or a semi name, which are clearly outperforming both of those, right? It's a opportunity cost type of setup. Do you want to buy something that's underperforming, or do you want to buy something that's overperforming? In this case, we can buy a sector and an industry group that is absolutely killing it in semis and software. So does it make sense to go buy an internet name like Adobe when we could be buying a software name like Microsoft at all-time highs, or a semiconductor name like a a large cap growth breakout like ARM, for example, or maybe even NVIDIA? I'm not going to talk about the earnings or whatever. So here we got the game plan. We got large cap growth is probably the place to be. We got tech, communications, and consumer discretionary as the sector, and the industry groups. We have semis, software, internet, and we'll see what's going on with consumer discretionary, right? So next step, let's build a scanner. We're going to use FinViz because it's the easiest to show you guys how to do it, but you can use any scanner you want. It does not matter. We use FinViz when we're doing these the deep dives inside of TTI, right? The Sunday night strategy sessions, we do it. And then every strategy session we have during the week on Monday and Wednesday, et cetera. We use FinViz because we can just copy and paste the links, right? So it's easy to build a scan and then copy and paste the link. So if you don't already use FinViz, it is free. I'm on a paid version. I have a little bit more capability, but you can use this for free as well. So first things first, we said we want to own stuff that is in the large cap. So what can we do right off the bat? Well, we can only factor through large caps. So I want to show you guys something. This is not necessarily going to be a webinar on how to build a scanner. I have one of those. You can search for it on the channel. But market cap, we have 9,480 specific things that we can scan for. By just completely eliminating everything that's under 10 billion, we just drastically reduced it to 759. And because I'm OCD about this, we're going to turn off ETFs as well. We now have 758. 758 from over 9,000. Not a bad start, right? But because we're focused on sector groups, let's go to tech first. So large cap tech, we have 125 names. We're not going to mess with industry yet. Let's look for, we'll do 50-day high last. Average volume, we're looking for things because it's a large cap. Let's get over 1 million. What is this going to do? It's essentially going to filter through stocks that either don't get traded often, or if you're an options trader, might not have any available open interest or volume to even trade it at all. So there's no point in even looking at it. This is not always going to work, but it filters out a lot of the crap. We're going to go to optionable and shortable. Make sure that everything has an options chain. This is usually not a problem for large caps, but small caps and mid caps it is. And let's just build a basic strength function. We'll do, today was kind of it was a down day, so I don't know how much the 50-day highs list is. Well, there we go. Okay. And look at how many software names are on here, right? So there's lots of different industry groups within tech, right? Communications equipment, hardware, electronics, components, semiconductors, and we know that semis and software are hitting new highs. And it just so happens that every single friggin' 50-day high today is either a software or a semi, other than two. So what we do inside of TTI is we click to the charts tab here. And what you're able to do really quickly inside of TTI, we look for horizontal level breaks. We look for stage 1 into stage 2 breakouts, easy setups that we can confirm risk, right? That's the whole point. And we scroll through all of this. Some of these times, or some of the scans, there's hundreds of potential setups, and it will take us 5 to 10 minutes to scan through it. In this particular case, it's not that big of a deal, right? We have a list of 14 names. We can look at them. Accenture, no idea if this is a good trading idea or not, but it looks like it's potentially a horizontal level break around 330. Adobe, this is an internet-related stock we were just talking about. Autodesk just reported. I don't know if they're up or down after hours, but they beat. So maybe they're up. This is a software name. This is the type of stocks that are probably going to be outperforming now over the long run because we're already seeing it from a sector and industry standpoint. Palantir is a trade that we're in, and we're up relatively large, triple digits in it right now. Let's actually go to 0 to 5% below the high, and we're going to get more names. So more names here. Essentially what this scan is going to do is instead of names that are already starting to break out, we're looking for stocks that are pressing up into overhead supply zones, up into resistance zones, and potentially just haven't broken out yet. By the way, need to point this out. If you're trading new 50-day highs and there's a high volume breakout, wait for the pullback before you get long. Do yourself a favor. 66% of the time on a high volume breakout, it does pull back. 0 to 5% below, you have a little bit of wiggle room. You can front run it. You can put it on your watch list and wait for a breakout and buy the pullback. There's a lot of different things you can do with these things that haven't broken out yet, but it is going to give us more names, right? So 53 names. Once again, we can just scan through this. A lot of these have already broken out, so they're not going to be tradable unless you can somehow wiggle your way into a setup where you can clearly define risk. CrowdStrike's the name that we're in. CRM actually doesn't look like it's too overbought. Looks like the 219, 220 entry point. Not a bad little setup there. But once again, all of these are from the leading sector on the year, and look at the quality of the charts. More often than not, these are up and to the right, which is what you want to be owning. You want to own things up and to the right. Microsoft, a stock that we've been in since 340. MU is a stock we wanted to get in at 70, but unfortunately we missed it. NVIDIA, we didn't grab, but we grabbed a sympathy play with ARM. Intel, let's go back to Intel really quick. Look at that. Who would have expected Intel that would be a leading stock this year? This stock has done nothing for 20 years. RIP Mike. PanW. Actually, we can talk through PanW really quick. This actually isn't the worst idea. Let's go to TradingView. So we've correctly identified large cap tech stocks. This is actually an all-time high close with PanW. I'm going to turn this into a candlestick chart so you guys can see it. By the way, if you don't know this, candlesticks give you wicks, right? Shows you open, close, high, and low. From a swing trading perspective, the close nose. Have you guys ever heard that? Easy way to get rid of all of the extra noise if you're just focused on the trend as a swing trader is go to a line chart. What's the only data point you get in a line chart? The close. So if you're finding it hard to look at trend and identify which way something is going, you can use a line chart. It does help clear things up. PanW, all-time high close here today. Why not own this above 260, currently trading 264? This is one of those plays that got gapped down on in an ER, immediately bought back up over the last 4 days, showing crazy strength with high volume. RSI is basing above 50, 3.04 ADR. For some reason, my VRVP isn't working today. That's really starting to piss me off. I thought it was just individual charts, but it looks like it's everything. So we have a new level at this 260 area. This is obviously a trade we've already taken. You can see the original trade. It was a winning trade. We're looking to get back long above 260. We're currently trading 264. So let's talk through this really quick. This is a tech stock, which is the number one leading sector. This is a software-related stock, which is the second leading industry group within software. And this is an all-time high post-ER. This is great. And this is a good setup. If you're looking for a software-related name breaking into all-time highs post-ER, so the catalyst is there, this is it. That's going to be a little bit more expensive from an options chain standpoint, but this is the idea of going through and finding the right stocks to own. This already has had the catalyst. It's in the leading sector. It's in the leading industry. It's in the leading market cap, right? Let's go through another one. PNW was a big win for us. But yeah, if you tried to front run the ER, you got bopped out a little bit. But that's okay because we are long CrowdStrike, and that held up very well through that. Let's look at Shop. This is something that I haven't looked at once. We traded Shopify. I'm probably going to have an old trade on here, so don't talk shit. All right, guys. There it is. You can see. This was a winning trade back in February. This is one of the first trades that were breaking out of a potential stage one. Was not an easy trade. We did get out of it with a profit, but it was not easy. Here we are once again, potentially breaking out. I don't think this is the most bullish chart of all time, but it does give us a clear level that you can define risk if you like it. Or post ER, volume is high. This is leading industry group. This is leading sector. Not the worst idea. Has a massive 4.32 ADR, meaning this thing moves on an intraday basis. It's good for options. It's good for shares. The RSI isn't overbought. Most people go, uh-oh, watch out. It's overbought. It's got to come back. No, it means the market fucking wants this, and it doesn't matter that it's at $70. As a matter of fact, if you cut the RSI in half, just draw a fucking line. If it is range bound above that 50 more often than not, you probably have an uptrend. That's how this momentum shit works. And it just so happens that Shopify has had an uptrend all the way since market low in October of 2022. So if you can clearly define your risk, not a bad setup here. This is a lot cheaper than PanW. So there's number 2, right? Let's go back and look at one more within this specific area. And then we're going to flip over to a different sector if we can find one more. Isn't trading fun? Uber, here's a trade that we took. Well, here, let's flip back really quick, and I want to talk through one concept, and then we're going to go through one more sector group. Let's take it to a line chart. Broad question here. Feel free to answer in chat. What's the indicator on the right? This is a custom coded indicator. It just puts all of the volatility metrics and volume metrics up for us. It's nothing crazy. Average daily range, average true range, and RVol are the only 3 things that I use on a consistent basis, RVol being relative volume. Okay, let's talk about this really quick. Apple. If I were to ask you really quick on an absolute basis, what is Apple up off of, we'll say, the beginning of the year? You don't need to know the answer, but it should be about 50%, something like that. 52%. Cool. Now, if I were to ask you, would you have rather owned Apple or Microsoft? You might know this is a trick question. Most people would have said Apple because it's fucking Apple and everybody is obsessed with Apple. Makes sense, whatever. What happens if I told you Microsoft has outperformed Apple by 20 to 25%? Well, it's not that far of a stretch. Microsoft is in the headlines right now because of OpenAI, all-time high, etc. Apple is not. But would you have been able to make that distinction back here? Would you have been able to make that decision to buy Microsoft instead of Apple as the market started to pivot? Would you have been able to do that? I'm going to show you how we did it. We're talking about relative strength. We're talking about sector, industry, market cap. In the confines of sector, industry group, market cap, Microsoft and Apple are within the same sphere, right? Same basket of stocks. They're mega caps, they're tech names, they're software names, etc. But what was the difference between Microsoft and Apple? How could you find which one is the better buy? They both drew down slightly during a corrective phase, topping in July, pulling down in towards the end of October. Microsoft drew down slightly less. There's your hint. What can you do inside of TradingView to figure it out? Microsoft divided by Apple. Obsessed Trader said earlier that relative compares one asset against another. So what are we doing with this specific chart? What is this telling us? You don't need any of the indicators on this, but I'm not going to turn them off. We're taking the absolute performance against Microsoft and dividing it by the absolute performance of Apple. And what are we getting? What is this trend telling us? If this is an uptrend, it means that the first asset is outperforming the second asset. Microsoft has outperformed Apple since the bottom of the bear market in October of 2022. That's how this shit works. Don't believe me? Apple against Microsoft. It should be a downtrend. And it is. Where did it top? In October of last year. When you have 2 assets, 2 stocks, 2 companies that you're looking to trade, they have relatively the same trading setup, which they do. Let's go back to Microsoft. Draw down into a descending channel, if you will, right? Doesn't have to be perfect. What did Apple do? Draw down in a descending channel. Like these were the same setups. Why did Microsoft outperform? Because the market cares more about Microsoft. It's not up for you to decide. I don't give a shit why the market cares about Microsoft. I had no idea that OpenAI was going to happen. I don't fucking care about any of that crap. But what I do care about is the fact that we were able to positively identify that the stronger asset out of the two is Microsoft. And when it came time to buying a position, you do not have an infinite amount of money. You have to make decisions based off of strength. And if you have an opportunity to buy the stronger asset, more often than not, you're going to make a better trade. That's how this shit works. Yeah, Microsoft is just a stronger stock going back to October of last year. Now, as a day trader, does this really matter? Not really, but hopefully you guys aren't day traders. If you're here, God bless you. I don't know why. You may like listening to me talk. But from a swing trading or a position trading standpoint, you need to understand that this shit matters. This will influence your profitability at the end of the year. If you can consistently find the strongest stocks within that basket of stock using another different, a different way. This is called, these are called ratio charts. And you could use them all the time, right? You can do SPY against SPY, Microsoft against SPY. Clearly, as you can see, we've already used this in our analysis, but once again, absolutely destroying the broader market. Why would we not want to own this? This will help you be able to find better stocks to trade. And that's the whole point of you guys listening to this shit. Key in on the sector, industry group, market cap, and then go find the strongest stocks. So once again, Apple versus Microsoft will give you that ratio chart. Let's go through one more quick demonstration on a different sector group within FinViz. Let's go through, I think communications was number 2, right? So let's go through communications, and we're actually going to take off the 50-day highs. So one thing I want you to understand about communications in all of these sector groups is that they're not equal weighted. So the larger companies are going to influence the broader sector trend more so than the shittier companies. That's how these non-equal weighted ETFs work. You can also run the same type of analysis on equal weighted ETFs. So for every major sector ETF that's not equal weighted, for example, XLC, there is an equal weighted component. I believe it's RSCP or something like that, which is essentially the same thing, but all of the components within it are equal weighted. And so it's truer to the trend of the overall sector. But remember, that's not always good, because if you can clearly buy a leader, you should own that. And sometimes in equal weighted stuff, you don't get that clear distinction. So I'm taking off the 50-day high rule so I can kind of prove that point. Communications is number 2 year-to-date leader. Look at the quality of the charts here compared to what we just saw with tech. We're seeing a lot of downtrends, like a lot of down and to the right. And this is the best performing sector of the year, which means that if a majority of these things are down and to the right, it's imperative to own the market leaders. Otherwise, you're going to end up buying shit. You're going to end up buying AMX. You're going to end up buying Comcast. You're going to end up buying Fox, this crap, instead of Google. So focus on the names that are leading within the sector groups, right? Google being one of them. This is a trade that a few guys inside of TTI are in, but I don't think there's an entry there, so we're not going to go through it. And by the way, if you didn't know, communications is the most recent sector to be added. So if you pull this up on your trading view and it only goes back about 10 to 12 years, that's why. Communications was just recently added, so there's not a lot of trading data. Let's go to Meta really quick because we're in the Meta play. So Meta and Google are the two that are sparring for the top spot in the year-to-date leader for communications. So if you don't know, I just dropped a video right before going live. It's a tongue-in-cheek comment. Oh, you're not long? Some stupid shit. I don't know. My editor wanted the title there. We'll see if people click on it. But we go through 3 specific setups, how we were able to get them right. First, we went through Microsoft. Second, we went through Meta. Third, we went through Uber, and then ARM. In this Meta play in particular, this is the third time we've traded it this year. Comms are up twice, or second most year to date. How are we able to actually catch this Meta play this time around? Well, if you look at something really quick, we look at Koifin, and we go, comms are up second most. If the market is starting to pivot, we're going to want to grab something in the communications sector. Right now, inside of TTI, we're really focused on quality over quantity. One of the reoccurring issues that a lot of swing traders have is that they open up way too many fucking positions. Inside of TTI as well. Sometimes, like 6 months ago, I was helping people try to close 30 fucking positions at a time. Never doing that again. So we instituted this rule inside of TTI that we are going to focus on 4 to 6 high quality positions through Q4 within that leading mentality and see how they perform. I'm going to give you guys a little elbow nudge. They're performing really fucking well, so take that into account. But communications here, we said if they're up number 2 on a market rebound, we're going to want to own this. I do not have a scientific way to tell you what this is called. We call it an oopsie. Blame JC Peretz and All-Star Charts. I don't know what the hell to call this. It's an undercut. It's a bear trap, whatever. We have some sort of horizontal level with a breakdown, sucked in liquidity for bears, and then a shot up. How do you call that in technical analysis? From failed moves come fast moves. So if you ever find this specific setup where you see some sort of level either to the upside or to the downside invalidated and then high volume bounce back, you can reasonably assume that this thing is going to fucking fly the other way on high volume and high volatility. So it did. And we decided when we noticed this, because we didn't trade it off the low inside of TTI, we do not focus on trying to buy every low. It's a fool's game. We would rather just join the trend once we have enough prevailing information to convince us that it's time to grab it. And so we went in and we said, well, what are the 2 major stocks inside of comms that we should probably own? To be honest with you, there's not many. We got Google, which at the time had got absolutely destroyed during ER, so it was just a harder position to rationalize owning. And from a technical standpoint, where the hell do you draw risk here? We're a horizontal level type of people. Very simple. We're simple-minded folk. This is not a bad trade if you're in it off of these lows, which we do have a couple guys inside of TTI that are in it. But it's a hard trade to adjust risk because if you bought somewhere down here, where the hell were you wrong? The 200-day moving average, maybe. It's just hard. Plus, you have overhead volume, overhead supply based off of previous price action, which you should see based off my VRVP that's not working. But let's look at Meta. Meta is the cleaner setup. So we decided between the two, right? Google and Meta. We said, which one do we want? We want Meta. It's cleaner. It's easier to risk at this 325 area. And let me show you one more thing. With this relative strength concept, Google, as the market was starting to break down, right, in July, Google essentially went sideways down towards ER and then gapped down huge. So at the time, we were looking at Google like, this is something we're going to want to own. This is showing relative strength. The entire market is coming down. Google is going sideways. That is relative strength, ladies and gentlemen. That is good for what building a watch list is during corrective phases because that's what you're going to want to own when the market bounces. But what did Meta do that Google didn't? It didn't fucking die on earnings. So it gave us a little bit more confidence to go Meta instead of Google. Once again, it showed a sideways consolidation range instead of correcting hugely down with the rest of the broader market. And so this is what we decided to grab. We decided to grab it in the middle of the range and front run it a little bit. So we were able to grab a profit cushion above 325, which we expected to happen. And here we are. It plays up over triple digits right now. But once again, it started with XLC. And then from XLC, which individual stocks are leading? It was Google and Meta. Everything else pretty much sucked. And above XLC, obviously, was the market cap, which is large caps. It all starts with the COIFIN stuff. It all starts with identifying where's the strength in the market cap, where's the strength in the sector, then go find the goddamn stock. So really quick, I want to point something out, and then I'm going to look at one more thing on the scans, or go through one more example, just to give you guys what it's been. Trying to bring this into about 55 minutes. I have like 7 minutes. What did you guys buy on Meta? I posted it. I don't know if I recognize your name, but I don't remember if you're on Twitter or not. We bought the 360 calls for March. So we got in around 315, and these are already up triple digits, so we have a free position. For those of you that aren't in TTI, we sell half of our position at 100% if you're an options trader. That way you can lock in a risk-free trade and let the other half of the trade, the only thing that you're risking is unrealized profits at that point. There's no risk against account capital. Let that thing go stress-free up to the price target. Works very, very well. Take that, steal that, use that, implement that. It makes your trading way easier, right? One thing I want to point out, though, what was it? Yeah, right. Got it. One thing I want to point out, what we're doing here today and what you've been doing, I didn't want to bring it up till the very end. There's 2 basic thoughts of trading. For those inside of TTI, you're going, God damn it. Here we go again. There's top down and there's bottom up. You guys ever heard of this stuff? Most people trade bottom up, which is fine. Most day traders for sure. But most people trade bottom up because they don't know that there's any other way to do this. Bottom up is you focus on the stock specific setup. Stock is number 1. You start here. What's number 2? The actual setup. So if you're a SPY trader, if you're an Apple trader, if you're a Tesla trader, doesn't matter what the market's doing, you're looking at that stock. Then you go and try to find a setup and then you take the trade, right? You trade it. You're at the mercy of the individual stock. Now, I'm not going to sit here and argue that it's an inefficient way to trade. It's an inefficient way to trade. But This is not, yeah, this is just an inefficient way to trade. But this is how most people trade. Okay, so they focus on a single stock or a basket of stocks. They really like trading Apple, Tesla, SPY, Qs, whatever. And then they hunt for a setup within that specific stock. They take the trade. Inside of a top-down approach, you focus on the thesis first, which is what we were doing with relative strength. That's what we do inside of TTI. There's other things. This is a very simplified version of this concept. Thesis first, and then we look for the individual stock that's going to fulfill that thesis, and then we trade. You see the validity? You see the difference? Instead of focusing on the individual stock and trying to squeeze a rock and get water out of it, maybe Apple's not doing shit today. Maybe you shouldn't be trading it because there's no gas in the tank on that Apple stock, so that there's nothing you should be doing. That's my rationale behind this. Instead, we focus on the thesis. Where's the strength in the market? And then can we find a stock that fulfills our TA requirements to be able to grab that thesis? We know we wanted to be long large caps. We knew we wanted to be long XLC, communication name, and we knew it was either going to be Meta or Google. That's it. It started here, though, instead of starting here. So there's two completely different ways to trade. Most people trade bottom up. They don't even understand that top down is a thing. I will tell you that top down approach is usually used by portfolio managers, money managers, and swing traders slash position traders, and bottom up is more so, I hate to say day traders, but it is, right? There's short-term price inefficiencies can generally happen quicker on individual stocks than full theses, right? So I do want to point that out, but there's a main difference. So everything that I'm talked to you about for the last almost hour has in the construct of a top-down approach, right? So if you're following what we're doing and it makes sense, you are going to be buying what? The same stocks as the fucking banks. You're going to be buying the same stocks as the institutions. I don't know why I put an N there. Can I spell? I've been in Brazil too long. I can't speak English anymore. Institutions. Yeah, you get it. Anyway, we're trying to ride the coattails of large money managers that have been accumulating positions, and we can find that through strength in sectors. I mean, this shit works. And that's all we're trying to do. We're trying to ride the coattails of larger institutions because retail trading doesn't move the markets. All right, guys? Retail traders don't move the markets. The fucking financial institutions do. Last thing I want to talk through is we're going to do one more. We'll do consumer discretionary here. Once again, there's only 57 names here, so I'm not going to go ahead and use any sort of performance filter set. We're just going to look through some of these. RIP anybody that's bought BABA over the last 2 years. Hey, let's use this. Let's use BABA. That's going to be that's going to trigger some people. Whoops, that is Discord. Sorry. LOL. Let's look at this really quick. Completely deconstruct this. Yes, I will post my email at the very end here. So let's look at BABA. Last 2 years, it sucks. Really nothing has happened. Shit, right? What can we utilize in this top-down approach to find sector strength? We use QWEB. So go ahead and either write this down, take note of this. KWEB. This is your Chinese internet ETF. There's multiple. So you decide what the stocks are going to do first? No, we decide what sectors and industries are going to do first, and then we go find the stocks that fit that idea. Whether or not they actually do, hopefully they do, but I can't tell the future. It's all about risk management at that point. And by the way, if you guys are looking at any of the setups that I'm posting here, this Fibonacci extension, take this with you as well. You buy at the 1, you sell your first portion at the 1.618, and you sell at the 786 as a stop, is going to give you a 2.98 to 1 risk reward every single time. So yeah, go ahead and take that. Okay, really quick, QWEB. If you're looking for, let's say, Chinese stocks, you're going to want to see QWEB break above and show strength here, right? From a sector group, QWEB is a great place to look for Chinese-related strength. Are we seeing it? No. Okay, so let me point something out. QWEB, we're not up and over 33.5. This is why we haven't bought Chinese stocks all year. I don't give a shit about Chinese stimulus. I don't give a fuck about what's going on with their real estate. I don't care. Until QWEB gets up and over 33.5, I don't give a shit about what's going on. But let's pretend we do. BABA is the name everybody wants to own. Very clear level that you can define risk. I'm not saying it's the best level to trade. I'm just saying that if you want to wait to get out of the woodwork, waiting up here where we've tested multiple times and have, for whatever reason, found supply and have bounced back down, probably the safest spot. Now, that doesn't mean it's the best spot to trade. You have to take risks in the market to make money, but that's what I'm going to wait for. Everybody is obsessed with BABA. Is there another major large cap retail related Chinese stock that might be bucking the trend? Well, I asked you a loaded question because I fucking know there is. It's PDD. Check this beast out. $157 billion company. It's a large cap Chinese retail internet related company. Baba has done nothing for 2 years but go sideways. PDD has done nothing for the last year and a half but go up and to the right. So of the two, which makes more sense to own? Now, obviously, in hindsight, it's like, well, no shit, buy PDD, not Baba. But what happens if we run something as stupid as think about this. I'm going to give you about 15 seconds. What direction is the line going to go? Remember, you're dividing the absolute strength of one asset by the absolute strength of the second asset. In this case, the direction of this line is going to reflect strength or weakness of Baba against PDD. We kind of already know which way it should go because PDD is an absolute beast and Baba sucks. What is this telling us? The opportunity cost of owning a Baba over PDD is immense. Shift click down. Look at this. Look at that underperformance. Holy shit, if you have owned Baba, you are just completely in the wrong realm of thinking, my friends. Let's go from the bottom of 2020 down here. I mean, still, it's almost at 50%. What the hell? That's why it makes no sense. People are like, Charlie Munger's buying. Warren Buffett's buying. Fuck Charlie Munger and Warren Buffett. They're some of the best ever, but they're not operating on the same time frame as us. We are swing traders focused 60, 90 to 120 days out. We don't need to own these things for decades. And by the way, Charlie Munger came out and said Baba was the worst business decision he's ever made. LOL. Just want to point that out. Anyway, here's the Baba chart. Once again, has done nothing and PDD has. So using this idea of strength between assets will allow you to make better trading decisions. In this case, it's a little bit easier because we know Baba sucks and PDD doesn't. Take into account the overall strength of the sector itself. Last rhetorical question. Long PDD, short Baba. That's hilarious. Sure. A little bit of a hedge trade there. What happens if Queb breaks above 33.5? Rhetorical question. There's no way for me to prove it to you specifically on this data set because it hasn't happened yet. But if Queb breaks above 33.5, what do you expect PDD to do? If it's already up and to the right over the last 2 years, is it reasonable to assume that PDD is going to rocket ship for fucking emoji? Probably going to be at all-time highs sooner rather than later if Queb starts to catch a bid. That's how this stuff works. Specifically in non-equal weighted ETFs. If PDD is outperforming everything, the market will reallocate more PDD shares within Queb. It's a self-fulfilling prophecy. So PDD is outperforming the market. Queb starts to break out. The ETF owners buy more PDD, thus shoving PDD up even more. Yeah, they could squeeze. I don't know if it's shorted or not, but that's the basic thought process. This is also why we haven't touched anything in China. Here's another one. This is a different Chinese internet ETF. Like, we're on this shit like flies on crap. Like, we want to own this stuff when it makes sense because this stuff can make you a lot of money, but it just doesn't make any sense to own this stuff. There are individual names like PDD, EDU. Like, these are bucking the trend. Don't get me wrong. But from a sector and industry group, there's just better opportunities with lower risk to be trading. This stuff in particular has absolutely killed it. This is a trade that we did take last year. We did make a couple bucks on, but we have avoided Chinese stocks the entirety of 2023 as a group. And that, for the most part, has been the right play. I can show you a million of these things that suck. Baidu, JD. I mean, look at this stuff. All of this shit sucks. Was it Neo? I think Neo actually doesn't look bad. Oh, I lied. Neo looks terrible. Here's the other one that doesn't look terrible. This is one I want to own PDD. I want to own LI when Chinese stocks start to catch a bid as an industry group or a sector group, right? So once again, I'm going to wrap this up. I'm going to post my email in the chat there. If you want to email me, feel free. But once again, focus on market cap, focus on sectors, focus on industries. And once you figure out where in the market you want to be operating, build a scanner. Once again, I'll flip back to the scanner. You can just literally copy the scanner settings for what they are right now. It's very, very basic. Build a scanner to find the actual setups that you like. Everyone's going to like something different. For us, we like horizontal level breakouts. It's very, very simple. We like things that have very little resistance, if any, to the upside because they tend to be cleaner breakouts. And so we'll sit there and we'll hunt and we'll hunt. Here's ARM. Last one. ARM is on the list. This is a name that we bought at the end of last week. And this is a 100% winner already for us. So we're able to hold this thing through the end of January with zero risk on account capital. I have no idea what's going to happen, but sure feels good to be in a newer IPO semiconductor name. Post NVIDIA earnings, it didn't die, and this is a free play. Sure feels great, right? So all of this stuff comes from that original thought process, okay? Okay, I'm going to type out my email. If you have any specific questions, feel free, hamiltondrips@thetradinginitiative.com. I appreciate you guys. If you leave a comment down below on this video or like it, I would be eternally grateful for you. And leave a suggestion on the next webinar. I have no problem doing this stuff. I hope you liked this over the slideshow. I'm looking for constructive criticism. I don't mind doing this stuff for you guys. I enjoy it. So just let me know in the comments below, all right? Enjoy your